Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about how much should you invest. Let's get into the video. One of the most common questions people ask when beginning their financial journey is simple: how much should I invest? The honest answer is that it depends on your goals, income, expenses, and stage of life. However, there are clear principles that can help you determine an amount that is realistic, sustainable, and aligned with your long term financial success. Start with your financial foundation. Before deciding how much to invest, make sure your financial foundation is solid. This means paying down high interest debt like credit cards, building an emergency fund, typically 3 to 6 months of living expenses, covering essential monthly expenses comfortably. Investing while carrying high interest debt can cancel out your gains. For example, earning 7% in the market while paying 20% interest on credit card is not a winning strategy. Establish stability first, then invest confidently. The 10-20 rule, a widely recommended starting point, is investing 10 to 20% of your income. Many financial advisors suggest aiming for at least 15% of your gross income for retirement savings, especially if you start in your 20s or 30s. Here is how it might look. If you earn 40,000 per year, 15% is 6,000 annually, which is 500 per month. If you earn 75,000 per year, 15% is equal to 11,250 annually, which is $937 per month. If 15% feels overwhelming, at first start smaller, perhaps 5%, and gradually increase your contributions as your income grows. Consider your goals. Your investment amount should reflect what you are working towards. Ask yourself, are you investing for retirement, a home purchase, a child's education, financial independence, wealth building? Short term goals under 3 years typically require safe, more liquid saving strategies rather than aggressive investing. Long term goals, 5 years, allow you to invest more aggressively because you have time to recover from market fluctuations. The longer your timeline, the more powerful compound growth becomes. Even small, consistent contributions can grow significantly over decades. Age and stage matter. Your age plays a major role in determining how much you should invest. In your 20s and 30s, time is your biggest advantage. Even investing smaller amounts consistently can lead to significant growth. Start early often matters more than investing large amounts later. In your 40s, you need you may need to increase contributions if you started late. Many people in this stage aim for 15 to 20% or more to strengthening retirement savings. In your 50s and beyond, if retirement is approaching, maximizing contributions, especially to retirement accounts, becomes critical. Catch up contributions can help accelerate savings. Income-based strategy. Another way to determine how much to invest is by breaking it down into steps. Cover essentials, housing, food, utilities. Build emergency saving. Contribute enough to get any employer retirement match. Pay off high interest debts. Increase investments gradually. If your employer offers a 401k match, always invest at least enough to receive the full match. That's essentially free money and an immediate return on your investment. Lifestyle versus investing. It's important to balance investing with enjoying your life today. Investing too aggressively at the expense of basic comfort or constant financial stress is not sustainable. A good strategy is to increase your investments when you receive raises or bonuses. For example, if you receive a 5% raise, increase your investment rate by 2 to 3% and enjoy the rest. Automate contributions so investing happens consistently without relying on willpower. What if you can only invest a small amount? Invest $25, $50, or 100 per month may seem small, but consistency is powerful. With compound growth, even the modest amounts can grow substantially over time. For example, investing 200 per month at the average of 7% annual return could grow to over 240,000 in 30 years. The key is starting and staying consistent. Small steps today create significant results tomorrow. Risk tolerance and investment mix. How much you should invest also depends on how comfortable you are with risk. Higher risk investments like stocks offer higher potential returns but fluctuate more. Lower risk investments like bonds or saving accounts offer stability but lower growth. Your investment amount should match both your timeline and your emotional comfort level. Investing an amount that causes constant anxiety can lead to poor decisions like selling during market downturns. Adjust as life changes. Your ideal investment amount is not fixed forever. Major life changes, marriage, children, career shifts, buying a home may require adjustments. Review your investment strategy at least once a year. Increase contributions when possible and rebalance your portfolio to stay aligned with your goals. A simple starting formula. If you're unsure where to begin, try this. Start with 10% of your income. Increase by 1% each year. Aim for 15 to 20% long term. Invest consistently. Stay invested for the long haul. The most important factor isn't picking the perfect number, it's building the habit. In conclusion, I believe, how much should you invest? The best answer is as much as you can consistently afford while maintaining financial stability and peace of mind. Investing is not about perfection, it's about progress. Start where you are, increase when you can, stay disciplined. Over time, your steady commitment can lead to meaningful financial growth and long term security. Thanks for watching this video and do not forget to subscribe to my channel.